Hello and welcome everyone to the third and final day of the 18th edition of India Conference at Harvard. In the last few months, we have been through a war and worse. The devastation that COVID has caused to the global economy, to people's lives and livelihood has been enormous. India is perhaps going through the most critical period since 1991. At this juncture, the Indian economy elicits reactions that is remarkably polarized and span the continuum from fundamental optimism and exuberance of gathering anxiety about near-term deflationary impulses. Warren Buffett famously said that in the business world, the rear view mirror is always clearer than the windshield. As the COVID deluge recedes, what lessons can the policymakers learn and what is the best way to repair the damage? These are some difficult questions to answer, and we are extremely fortunate and thrilled to have four brilliant minds to help us think through the issues. We are joined today by Mr. Montek Singh Ahluwalia, former Deputy Chairman of erstwhile Planning Commission, Ms. Pranjul Bhandari, Chief India Economist, HSBC, Dr. Jahangir Aziz, Head Emerging Market Economics, JP Morgan, and last but not the least, our moderator for the panel, Ms. Ira Dugal, Banking and Economy Editor, Bloomberg Quint. Before we begin, audience members are requested to please use the Q&A function that you see on your screen to post your questions. Also, please make use of the upvote or like function in the Q&A window. Questions that are upvoted the most will appear at the top of the list and will be answered later by the panelists. Finally, please do tag us with hashtag ICH2021 when tweeting your favorite moments and insights from the event. Now, without further ado, requesting Ms. Ira Dugal to kindly commence the panel.
Abhishek, thank you so much. Welcome to everyone who's joining this conversation. Good evening to those joining from India. Good morning to those joining from the US. The theme of the conversation is what happened to India's growth story. And I think that alludes to the steady slowdown in growth that we'd seen since about 2016. But instead of going straight into the past, perhaps it is a good idea to start with where we are, look ahead, and I assure you that as we look ahead, we'll find ourselves debating many of the issues that we were debating between 2016 and 2020. So that's the approach that we hope to take in this conversation. I'll start with broad comments from each of our panelists. And Dr. Ahluwalia, to you first. As you have been watching, reading, and seeing the growth numbers pick up, or rather the contraction turn into growth, hopefully in the December ended quarter numbers for which will be out shortly, heartening, no doubt, but do you treat them with a degree of caution till we have some indication of the durability of this recovery, sir? Dr. Ahluwalia, I believe you're on mute, sir.
Yeah, it's always a good idea to tweet. Am I okay? Can I be heard?
Yes, yeah. Dr. Ahluwalia.
Well, I mean, the point you raised about caution in interpreting growth numbers, if you're referring to factual position, I mean, there's a lot of debate right now in India on how much the GDP has contracted in the current year. And, quite frankly, opinions vary quite a bit. The official estimates, as you know, are about 7.7. Many people think this underestimates the contraction because it doesn't reflect what's happening in the informal sector. I won't go into all of that. Whether it's 7.7, 8, 9, the important thing is that what is happening this year is not a reflection of India's growth potential at all. And I mean, if it's gone down, I mean, it's gone down in many countries. And our expectation is that in the coming year, you'll see a recovery. I mean, in some sense, the recovery has already begun because the economy fell off a cliff and is now climbing back up. There are different views on whether this is a V-shaped recovery or a U-shaped recovery or a K-shaped recovery, all of that. But I think whichever way you cut it, the economy is getting back to normal. Not everybody is recovering at quite the pace that others are. And it's not really clear what the informal sector is experiencing, but whatever it is not good. However, my guess is that in the coming year, that means 21-22 fiscal year, I mean, if it went down by 8%, it'll go up by maybe 8, maybe 9, or something like that. I don't think that growth rate is at all relevant in judging what the growth potential is. I mean, the real question is, from next year onwards, next year being 22, 23 onwards, are we just going to go back to where we were pre-pandemic? Or are we getting back to where we were several years before pre-pandemic? Because in the 3 or 4 years after 2016, the economy slowed down. And that's the real question. I mean, it's quite clear to me that if we just go back to between 4 and 5%, that'll be a very poor performance and will have very negative implications for employment growth, equity, and all the rest of it. So there is, in order to get back to a growth rate that is actually generating a broader spread of prosperity, we need to get the economy back to 7 plus. Now, what does it take to do that? Now, to my mind, it takes setting the macroeconomics in order, whatever that means, and at the same time, putting in a lot of reforms that would unleash productivity, the whole thing in an environment in which investment recovers. I think a key assumption here is that I think government and everybody else, I think they're talking about a private sector investment led recovery. In the short run, while the private sector is quite dormant, of course, you can do a lot of public investment. It's not a bad idea. But I think we need to ask ourselves by 22, 23, will the private sector be in a position to do a lot of investing? And we need to examine, if it isn't, why isn't it? Because the big decline in growth is really due to the collapse in investment. Most of it is due to collapse in private investment.
And we'll come down to those specifics in the next round of questions, Dr. Ahluwalia. Jahangir, to you, I think your latest article, you called us either outdated or antiquated in the way we are measuring growth. You prefer to look at it on a quarter-on-quarter basis. But does that analysis leave you at any different place in terms of the strength of the recovery and the durability of it?
I think it does in some sense. I mean, what Montek said is in general the right way to look at it. But I think that in order for us to sort of make a better, have a better look at what policies work, what policies don't work, I think it's important to get away from these year-on-year growth numbers, which are sort of meaningless. No one has done that in the last 30 years. We continue to do that. So if you look at what happened in the second quarter of calendar year 2020, when the pandemic hit us, if you look at the quarterly momentum in level terms, the level of GDP fell by 24% compared to the first quarter. If you look at what happened in the third quarter of 2020, which is the second quarter of the fiscal year, in level terms, GDP rose by 21% compared to the level of GDP in the second quarter of 2020, and we expect in this quarter we'll get the results next week, in a quarterly basis to move up another 12-13%, and that will leave for the year as a whole Indian GDP about 6.5% lower than what was in 2019-20. And if you look at the momentum of activity that is taking place, and while there are, and I'll come to the risks, we are expecting, for a year as a whole in 21-22, India to grow by 13.5%. I know these are very large numbers. We in the street, we are probably in the most optimistic about both what is going to happen in 2020, in the fiscal year 2021 and fiscal year 2022. But the broad point is that even if you take our more optimistic view of the world, at the end of fiscal year 2022, even with this very high recovery that we are looking at, in level terms, GDP will still be about 5 to 7, 8% lower in level terms, lower than what the pre-pandemic path would have been. And that translates roughly into about $200 billion of loss of income in the year 2021 and in the year 2022 taken together. We know for a fact that, at least looking at the last quarter's listed companies' profits have gone through the roof. It went up by 30%. That's what the RBI numbers are. So this $200 billion loss most likely will fall almost entirely on the rest of the economy, which is basically the household sector and the SME sector. And it is unimaginable to me that that kind of an income shock is not going to leave behind significant scarring on the balance sheets of both the households as well as SMEs. And it is this risk that we are looking at, that whether this growth bounce is just a dead cat bounce, or whether we genuinely go back to any kind of a sustainable path, not even what Montek said, going back to before the 2016 path, or even the last 4 or 5 years path, which is not that good of a sterling growth. Even that requires us to take a deep breath and assume that that kind of income shock is not going to have severe damage to balance sheets of households and SMEs. If that happens, it is very difficult to see how even this growth can be sustained. And what is unfortunate is that that's not the way the government is looking at it. That's not the way most of the market is looking at it. If you look at the government's fiscal policy thrust, as Montek pointed out, is, well, let's do a little bit of investment. And by the way, the entire increase in the budgeted public investment is 0.2% of GDP. And there is almost nothing in terms of income support. And if you look at not just India, don't look at India, look at what's happening in the US, what's happening in Europe, what's happening in Brazil. All of these countries are focusing on income support for a reason. It's not to boost near-term demand. That's not going to happen. If you're closed down, if you're locked down, you're locked down. You're not going to spend. It is to preserve, damage to the household and the SME balance sheet. So whether or not even we get back to what kind of medium growth, whether or not we even continue with the recovery in the second half of the year, even though we have 13.5%, depends entirely on how much damage is going to be done to balance sheets of households and SMEs.
Pranjal, that links into some of what you've written about most recently in your report. I think you asked the $1 trillion question and you said, yes, growth recovers, but what next? And you have 4 broad parameters in trying to answer that what next.
Yes, certainly. So, I agree with everything Montek and Jahangir have been saying. I think the growth we are seeing right now is a reflection of pent-up demand. It was goods demand last couple of months. Next couple of months is probably going to be services demand. There's also going to be a sense of overshooting, when we see the cyclical recovery this year. But what happens when this entire pent-up magic is gone? What's going to really support growth? And that's where I think India was lacking a medium-term growth narrative. Thankfully, the budget sort of planted an idea. I think the main idea it planted was, capex. It tried to increase outlays. It tried to announce frameworks like the bad bank. But will this be successful? Will this be good enough to give India medium-term sustainable growth? Our own sense is that potential growth has been falling from north of 7% a decade ago to about 6% on the eve of the pandemic. And we worry that it could fall to about 5% once the pandemic is behind us. Is there any magic that can happen to begin to start raising, potential growth again? And here there are 4 things, I'm watching out for in the next quarter. I think the first thing I'm watching out for is this big disinvestment plan of the central government. There's a huge capex plan, but when disinvestments disappoint, the capex is the first thing that is cut. So that's one thing I'll be looking at. The second thing is this entire sort of mixed strategy of doing both exports promotion and import substitution together. Whenever India's tried to do both together, it's been a mess. For example, the 1970s, India is going to announce a new customs duty strategy in the next couple of months. Let's see what it's batting for. Is it batting more for import substitution or more for export promotion? I'm really hoping it's the latter. The third one is on reinstating the insolvency and bankruptcy code. That's probably the only mechanism to deal with corporate debt in the country. And unfortunately, it's been suspended through the pandemic. How quickly it's brought on board and how quickly it's improved is going to be very important. And finally, as Jahangir said, social welfare schemes. If you don't protect the bottom of the pyramid firms and workers, then you have a big demand problem down the line. We're already seeing that the demand for Narega schemes is far outstripping the supply. So will the government be ready to give as much money to social welfare schemes over the next year as it was in the previous year? I think these are four things that will answer whether this cyclical recovery can be translated into something more structural, or is it just something that's going to fade away?
All right, I'm going to get into specifics now, but before I do, I'm just going to request the panelists that when they're not speaking, if they could just press on their mute button, an echo comes across otherwise. Let me dive into the specifics of infrastructure, and Dr. Ahluwalia, I'll start with you. As one has seen this conversation about let there be a government infrastructure push, let there be a development finance institution, one can't help but wonder as to what's changed. Why is a development finance institution going to be any more successful today than it was 15, 20 years ago? Why is an infrastructure push now not going to create the same kind of sort of balance sheet stress for banks that it did earlier? Is there anything different in our contractual environment which will allow infrastructure, this infrastructure push to be more successful? Are we asking those questions? Are those the right questions?
Yeah, no, those are certainly the right questions. I'm going to go back to what Jahangir said. We tend to get carried away by memes and sort of references to capital expenditure. I mean, as he pointed out, and he's right, the actual increase in capex in the budget is 0.2% thereabouts of GDP. Now, therefore, there is certainly an increase. But we're talking about an environment where growth has collapsed because the rate of investment has fallen by about 5 percentage points of GDP. So, of course, it's a good idea that we've got a teeny bit increase in capex, but this is not going to make any difference to whether growth recovers from the investment point of view. The other point, I think Pranjul mentioned that we tend, I'm not referring to the present government only, in the budgets, we always announce schemes that this thing is going to be so many 100,000 crores or whatever it is over the next 5 years. But of course, the actual provision for it in the course of that particular year is minute. And in the old days, when you had sort of a planning discipline, somebody was adding up these different estimates and seeing whether they fit into whatever is the macroeconomic capability of the budget. Today, that doesn't exist. The budget statement normally contains, for the next 2 years, a trajectory of the fiscal deficit and also some of the basic numbers and the growth rate. This time, it has the data it has a projection for 21-22. It has nothing for the next 2 years. And all we know is that the fiscal deficit is going to be brought down to 4.5% in the year 25-26. Now, let me take I don't know if I'm talking too much, but let me just make a very small point. If we agree that we need to bring about fiscal consolidation, I mean, the initial big increase was, of course, in my view, the right thing to do. And personally, I think the government should have accepted in the very first 3 months that we're going to have a big decline in GDP. Therefore, the fiscal deficit is going to be expanded. That didn't happen. And today, we're talking about an increase in expenditure, but most of this is going to take place in the last 4 months of the year, because up to October, expenditure was actually lower than in the previous year. Okay. Now, if we are to forget about those who say that, look, 4.5% is too high. It is a bit on the high side, but when you're starting from a position where it has gone through the roof, maybe you need to be a little more cautious, but never mind. From 21-22 to 25-26, we want to bring the fiscal deficit down from, let's say, 6.8% to 4.5%, which is about 2.3 percentage points of GDP, reducing the fiscal deficit. But in most of the discussions that I've seen about the kind of vision we want for the future and the role of government, there are huge commitments being made for increase in expenditure. I mean, for example, virtually everyone says we need to do more for infrastructure And public sector alone should be doing 1 percentage points of GDP more for infrastructure. And of course, to that, you have to add a lot of the private sector in the public-private partnership mode. So that's 1%. Everybody says we need 1% more in health because health expenditure is too low. So that takes it to 2%. Everyone also says that we need to do a lot more on education, which is also correct. So add another 1% there, so you get 3%. This is over a 3-4 year period, right? Plus, research and development. I mean, there's no question in agriculture, if you're looking at climate change, if you want to get ahead with competitiveness, and India is spending a ridiculously small amount of money on research. And while much of the increase must come from the private sector, there's no doubt that government research support has to increase. So you add another 1% on that score. And frankly, if you look at defense expenditure, take a look at the geopolitics of the region. We are seeing a decline in defense expenditure as a percent of GDP to well below 2% of GDP. The kind of geopolitical situation we face and the kind of threats we have to deal with, it's a no-brainer that we need to increase defense expenditure as a percent of GDP, maybe by 0.5%. So, frankly, when you add that all up, then the vision for the future involves an increase in government expenditure, maybe 5 percentage points of GDP, and a reduction in the fiscal deficit around 2.5% of GDP. That is a fiscal turnaround of 7.5% of GDP. And this doesn't include Jahangir's favorite universal basic income scheme, which he, I think, quietly sneaked in. I'm kind of assuming that if you want to do that universal basic income scheme, you could only say, I'm abolishing X, Y, and Z subsidies and substituting them for a universal basic income scheme. But even if you take that approach, how are we going to get a 7.5 percentage points GDP turnaround in 4 years? It's a no-brainer that most of that has to come through higher tax revenues. Because, the Finance Commission has put its imprimatur on this estimate very recently, that India's tax to GDP ratio is 5 percentage points of GDP less than it should be. And you can quarrel with the reason they're saying so, but most other studies have come to the same conclusion. This is India, given India's position. So to my mind, if we're serious about reform, the most important thing to answer is how are we going to do this? I personally think this cannot be done by waiting with bated breath for the next budget to see whether tax reforms are introduced. I think we should appoint a truly high-level committee with lots of people with an international expertise to outline what are the broad directions of reform in our taxes. And one of the critical things there has to be, in my view, something that Pranjul touched upon, we can't use customs duties as a source of revenue. So the most recent increases in customs duties, in my view, go in the wrong direction. I've written about it, so as have many other people. You need to put across a holistic picture. And frankly, a lot of that has to do not with tax rates, but the way taxes are administered. If you talk about ease of doing business, the biggest complaint that businessmen have is the great uncertainty about tax liability. And if we keep making unrealistic assessments of how much revenue can be raised, all that happens is that the tax authority, the tax officials are given very high revenue targets, and not surprisingly, they try to meet them by making unreasonable assessments, and you have a complete mess. That needs to be addressed. Now, maybe it will be, but the budget doesn't tell us anything on that score. Now, there are other points which Pranjul mentioned, and she's right. The bad bank idea has been around for 3 years. So personally, I would like to see the exact details of it outlined, and we could see a timeline for implementing. Same thing is true for privatization. Although there, I think I would give credit to the government because it's the first time that they have said we actually want privatization of all except a few enterprises in strategic areas. I mean, Vajpayee's government tried to do that for selected enterprises. And that was Arun Shuri, who was the very dynamic minister. But, you know, the experience of that is not very good because he was charged with all sorts of improprieties, and the civil servants involved in it spend a lot of time and energy defending themselves against those charges. So getting this privatization done is not going to be easy, quite apart from the fact that there will be resistances to overcome. So these are some of the things. I mean, I'm not saying, by the way, that these are impossible to do, but the least interesting thing is the announcement that we're going to do it. If it's not accompanied by a clear game plan, you're not even starting the debate.
No, absolutely. And Jahangir, perhaps you could comment on that. I think Dr. Ahluwalia makes a great point. You know, we tend to go straight into the announcements and start, you know, wondering whether they will or will not play out. But maybe the first step is to look at the big macro plan. If Ratan Roy was here, he would be, you know, asking what is our growth model? First, answer that, and then go beyond that. And certainly, the numbers have to be, you know, have to add up to some of these sort of promised infrastructure push kind of announcements, which you know, one hopes will give some sort of impetus to the economy beyond FY22.
Right. So, I mean, I think you know, if you go back to early mid 2000s, you know, and I'm not saying that just because Montek is over here, but you know, he championed the cause for infrastructure push. He's the one who came up with the slogan of $1 trillion of investment. But if you look at the plans that he had, one of the things that he would focus on is how do you fund it, right? And there was a sense of this is how much domestic savings is there, this is how much the banking sector can do, this is how much a foreign investment can do. Now you fast forward to 2020-21, right? And you ask the same question that, you know, you can have, and I'm not going, I take Montek's point that it is very difficult to do all of this without a substantial increase in tax revenue, and that tax revenue increase cannot come from customs duty, which Pranjal is pointing out. It has never come from customs duty. But, you know, one of the questions that you ask in terms of implementing such a large disinvestment program, or government, public sector, whether or not that is the right way to go about it or not. And I disagree that that's the right way of going about it, but we can talk about that later. But just in terms of the details of it, you need to go, fishing where there is fish. It is pointless going to fish where there isn't any fish. So look at where is the largest inflows are coming? Where is the place where the global economy has liquidity, and which is the pool of liquidity that you can tap into? And it happens to be basically bond flows. So just to give you a sense, between January of 2020 and January of 2021, in emerging Asia received $158 billion of bond flows, of which $155 billion went to China. In the month of January, China received $35 billion of bond flows. The rest of Asia, including India, received $2 billion. And where is it? What is it that we have opened up over the last? And I know I'm treading into controversial waters over here, but what is it that we have opened up? We have opened up everything, including FDI and insurance now. Right? What we haven't opened up is the place where people are willing to put money in. So if we are going to go and say that, well, I'm only going to look for blue fish when the rest of the sea has yellow fish, then it's very difficult to see how, in terms of implementation, we can actually move forward in funding even these kinds of, and I'm not even going to Montek's 7% of GDP of additional spending. I'm just looking at this current level of spending. Where are we going to fund them if we are not going to go out and say, look, for better or for worse, this is where the world is putting money in. This is where we need to go. It is pointless going where the world is not putting money in. So I think there has to be an exercise that looks at what is the infrastructure need? How much can the private sector actually deliver on that? And that goes to the heart of the problem, which is, do these old public-private partnership contractual arrangement work? We know that it hasn't. We need to figure out what is a better way of fixing that. Then look at, where will that funding come from, both for the private sector as well as for the public sector. And we really need to do that arithmetic. It is pointless putting out numbers and saying that somehow or the other, these numbers are going to get funded. And I think that exercise was done back in the mid 2000s. I think 10 years have gone by, the world has changed, the financial conditions have changed in India and abroad, and I think we need to do that number. And I think unless we do these kinds of actual nitty-gritty, almost boring but very crucial arithmetic, it is very hard for us to go and say that this is the way forward, this is how magically we are going to reach that number. And I don't think we are addressing that in terms of I'm not even going to the very minute details. I'm just going into the second level of details that you need to have. So I think unless we address the private-public partnership contractual arrangement problem, unless we go and actually seek out where truly there is funding, which pool of liquidity actually will come to India, change our financing and change our own capital market regime to attract that flow, I think it's going to be a very hard hill to climb.
Pranjal, jump in on that if you want. I do want to add a little bit of sort of a ray of hope, if you may want to call it that. We have seen at least private sector balance sheets repair a little bit, and where banks are concerned, we have seen a little bit of sort of capital raising. So if one sort of compares the post-COVID scenario to where we were before COVID hit, and we were still worrying about the twin balance sheet problem, there is some small degree of improvement. So perhaps there is reason to believe that there would be the capacity to, for private enterprise to come back into investment.
Yeah, Ira, good you asked that, because if you look at corporate and bank balance sheets, particularly last couple of quarters, things do seem to be better. So there is some corporate deleveraging happening if you look at corporate debt as a percent of GDP. But a lot of it is because bank credit to corporates are falling, as in bank credit to industrial sector is decelerating 1.2% year on year. So it is just, the deleveraging is just happening for a reason which is not a great reason, that banks don't want to lend to industry anymore like they wanted in the past. And then if you scale corporate debt by profits, so if you look at corporate debt upon profit, rather than corporate debt upon GDP, you find things are looking even more dismal. And that's because, profitability has been falling for the last decade. And then if you look at debt to equity ratios and you compare it to other EM peers, you'll see India is sort of, quite on top. We're one of the most levered corporate debt economy. And then if you look at some domestic indicators like interest coverage ratio, which sort of signals how well companies are being able to pay their interest obligations, things are worse than the long-term average. So, by one or two metrics, things are better, but they are definitely not good enough. And if you then look at banks, you'll see that some of their capital cover has improved. NPLs have peaked in March 2018. It's been falling since. But the truth is that we don't know where NPLs are going to go from here. If you look at previous episodes of slowdown, NPLs never rise in the year of slowdown. It always rises 1 or 2 years later, because in the year of the slowdown, there are many emergency steps that can be taken. So there's a huge amount of uncertainty, on where this is all going to go. And this is the time when we need the insolvency and bankruptcy code. And I'll just come back to that again, because I think it's very important. And this is exactly the time, when we've suspended it. And even before the pandemic, there was a long queue of 10,000 cases, waiting to get admitted into the IBC forum. So we have that to take care of, and then everything more which will come from the pandemic here. So look, in some sense, things are better because NPLs have come off, but there is a lot more improvement that is needed at this point. You're on mute.
We'll go across to the Q&A in about 5-7 minutes, but I'll just get one round of comments on sort of the spending capacity of the households, and Jahangir alluded to that. I don't know if we have Dr. Ahluwalia, if he's dropped off. But let me go to Jahangir in the meantime.
Sure.
Jahangir, you alluded to this, of course, in your initial comments as well. But I think the question being asked is that if it was leverage which was driving consumption spending, in the years before the COVID crisis hit, it's very difficult to believe that that may continue or resume in the post-COVID era, apart from the sort of behavioral change that will come. Like you said, household balance sheets, at least in some segments, would have taken a material hit. So domestic consumption story is also a little bit of a question mark.
Look, I mean, I never bought the domestic. You've heard me talk on your interviews. I never bought the domestic consumption story. So let's just step back and take a deep breath. So let's go back to the early 1990s. Let's go back to Dr. Manmohan Singh and Montague's reforms in 91, 92. Let's begin the story there. Private consumption as a share of GDP was 67%. Private consumption as a share of GDP has fallen steadily since then, reaching a bottom around 55% of GDP back in 2015-16. And since then, it has increased by 2 percentage points of GDP to 57%. That's it. The entire story of India has been driven by two variables. One is private sector investment. So whatever investment numbers the CSO gives us, take out public sector investment, it's private investment. A rise in private investment from the 10-12% levels to the 27-28% levels by 2011-12, a decline of that taking place. And the fact that alongside that, it was exports. Exports as a share of GDP going from the 6-7% in the early 1990s to the 25-26% in 2013-14 and falling. And if you draw these two charts, it's not rocket science. If you draw these two lines, there is almost no daylight between investment as a share of GDP and exports as a share of GDP. There is absolutely no correlation at all between private consumption as a share of GDP and investment as a share of GDP. So almost more, except for the last 2-3 years, where I agree with you that leverage-based consumption has been the one that has kept the economy more or less going. But remember, economic growth in the quarter before the pandemic was 4.1%. So it wasn't really. So I think the point is that I think there is a entrenched and almost zealous belief that India is a closed economy. We know for a fact that India is far more open than we think we are, but not just in the real economy, where, as I said, the entire upswing in investment and the collapse in investment is almost entirely explained by the upswing in exports and collapse in exports. But also in the financial sector. We all went to sleep on Friday in 1 September in 2008, knowing that Lehman had collapsed. The interbank rate that night before going to bed was 6.5%. Monday morning, it hit 14%. By Tuesday, it was 20%. If India was such a closed economy, why did the global financial crisis in the London money markets take just a weekend to hit us? So, and you don't even have to go very much further. Just go to the last 1 week. Indian bonds sold up 30 basis points. Why? Because the US Treasury sold off. So what I'm saying is that we tend to believe that India is a very closed economy. We tend to pride ourselves in the capital controls, etc., that we have put in place. None of them has ever worked. India is a far more open economy than we think it is. Private sector investment is key to it. Unfortunately, private sector investment peaked back in 2011-12. It has been declining since then. Corporate investment peaked in 2007-8. It's been declining since then. These are stories that have taken place long time back. And I think that in sense that, whether or not we are able to get out of, where we are depends almost, entirely on whether we accept reality. And the acceptance of reality is that India is a very open economy. India is just like any other emerging market economy. And the last time I told you that, you had a
Yes.
complete consternation on your face. It's just another vanilla emerging market economy.
Yes,
It
that
bleeds
those are
like,
those are the exact words you used. You guys think you're
yeah,
special, but you're just a vanilla
yeah,
emerging market economy.
there is no such thing as India exceptionalism. India bleeds like every other emerging market economy, and India has to do like every other emerging market economy, a soul searching. And the soul searching is that, do we pretend that the world of global trade going up by 8, 9, 10% a year, will it come back? Or since it hasn't come back for the last 10 years, will it come back? Or it won't come back. If it doesn't come back, we need to search for actual policies and reforms that look for alternative engines of growth. I'm not saying that, India with a $2,000 per capita economy can ever grow without relying on exports. Exports is a very important part of it. But this is a shrinking pie. And we're trying to get a larger and larger share of a shrinking pie, which is very, very difficult. We need to seriously think about going back to your question of actually using domestic consumption, whether it's through leverage or whether through reforms. And there are many, many reforms that can be done, many regulatory changes that can be done to use that as a sustainable source of a demand driver. China has done that. And China is the only emerging market country that is far less immune to what is happening globally than we are. And I think that, to answer to your question, I think, yes, there is a problem with that. It has been driven by leverage. Leverage is going to get pushed back. As Pranjul said, you are going to see a massive increase in pent-up demand for the next 2-3 quarters. What after that? And if we want to have any kind of sustainable increase in consumption, we have to go back and ask ourselves the question, why do Indians save more? And my answer to that question is that Indians don't save more because they're Indians. Indians save more because in terms of regulations, in terms of monetary policy, in terms of fiscal policy, there is an enormous amount of financial repression in this economy, which forces Indians to save at these very high levels. Once you accept that, you remove this financial repression, you reform capital markets, you reform regulatory environment in the economy, and you can actually get in. I'm not saying it's going to be non-leveraged consumption. Consumption will remain probably leveraged, but it'll be a sustainable consumption as a additional driver of growth than just relying on exports. But the key is to go back and say, do we really believe that magically globalization and global trade is going to come back tomorrow?
Pranjul, to what extent do you agree with Jahangir's thought process, and then I'll open it up to questions.
Yeah, sure. Look, I do, I do agree with him in almost all parts. But here, I just basically wanted to, add something new. I think, we've not yet discussed. The problems of 2019 are back. As in, we're going to see 1 year, 2021 is going to be a year of cyclical excitement, and then once pent up demand is gone, then in next year we'll be thinking about all the problems we were talking about in 2019. And I think before we reach there, I think we really need to think through carefully that what really went wrong in the last 10 years, as in what kind of policy setting didn't work for us, and how can we change that. And 3 things come to my mind. One is, does shock and awe work for us? A policy change that happens by shock and awe, for like demonetization, does that work for us? And in my sense, the answer is no. I think this economy is just too diverse, too large, and the sort of settling back into a new equilibrium costs are extremely high. So I think that's probably one policy lesson. The other policy lesson that I've taken, away from the last 10 years is the fact that, we have to think about the informal sector. We can't wish it away. In fact, it should be center of stage whenever we are thinking about economic policy. When we had the lockdown, we didn't realize the reaction function of informal workers. 30 million of them walked back home. Why did we have inflation all of 2020 when nobody else had inflation?
Yeah,
Because
Mr. Bhatt. Okay.
So, we can't really wish away the informal sector is my sort of second learning. And my third learning is we can't fire and forget. A lot of reforms, when they are implemented, will be messy, but we have to continue to improve them. And have we done that in GST? Because if we don't do it, then it sort of doesn't really live up to its hope. You may recall that when GST came, everybody was talking about how potential GDP growth will rise. And what has happened since is potential GDP growth fall. So I think these are 3 policy takeaways for me from the last decade. And I hope we can really internalize it, as we move into the next year when the pent-up demand will have gone.
We have Dr. Ahluwalia back in time for the Q&A. So I'll start with the questions that are coming through from the audience. The first one, Dr. Ahluwalia, is addressed to you, and it reads, what is your take on IMF's projection of 11.5% growth and the government's target to reduce fiscal deficit? Also, what do you think about the government's vision or promise of attaining $5 trillion in GDP? I'll add a timeline there by 24-25 is what they've said, I believe. Also, the second part of that question is whether you think divestment and privatization will play an important role in economic growth.
Okay, that's a lot of questions.
Yes, I know.
I think the first one related to the IMF's projection, right? I'm not aware that the IMF actually does some independent projections. I think they put together whatever the official projection is. I have no idea. My guess is they're just repeating what the official numbers are. So I wouldn't give them any greater weight than you would the numbers emerging from the government. I mean, it does say that I should add, by the way, that, and this is something that Jahangir might want to comment on, the IMF says that after having grown at 11.5%, we are then going to grow at 6.8, which to my mind would be pretty good the next year. So quite frankly, I would disregard those as not being very significant. What was the second question on the IMF? You're muted.
Mute.
Sorry? You're muted. Can you unmute?
Yes, sorry, Dr. Ahluwalia. The second question was on whether you think the government is on track to achieve the $5 trillion economy.
Oh, the $5 trillion.
Which I think
well, I think, I don't think the government, unfortunately, has officially retracted the 5 trillion number. It's obviously not going to happen. But to be fair, many people say we're still going to get to 5 trillion. That's certainly true. I mean, if we grow at 1%, we will hit 5 trillion at some point. So don't take that too seriously. I think the key thing was what I mentioned earlier. The finance minister has not, in her budget speech, mentioned what she expects the growth rate to be in 22-23 and 23-24. And that would have been a real indicator, because I don't think the 21-22 growth rate is really all that critical. While you have me, before I get cut off again for some technical reason, let me just disagree a bit with Jahangir. Because I think Jahangir's notion seems to be that we should now rely on internal consumption. Now, I don't think the Chinese example is relevant here. China was massively under-consuming. I mean, it had a ridiculously high savings rate and far too high an investment rate. It made a lot, I mean, if you go back to the G20 discussions over the last 10 years, this was meant to be a normalization, and I think they've done it brilliantly. I'm not aware that anybody said that we should be increasing our consumption levels. The truth of the matter is we don't have a national savings rate consistent with what we think is needed in order to grow, in order to sustain the investment rate we need. So, I mean, the idea of stimulating consumption to revive the economy as a medium-term strategy doesn't actually make sense. Of course, in the short run, if you've got a massive loss of income at the lower levels, I mean, we should have done more. We did something, but we should have done more to sustain incomes at the lower levels, which would have helped provide demand support for the economy.
Pranjal, I'll throw 2 questions from the audience your way. I'm clubbing 2 questions, actually. One is on the role that divestment and privatization will play in the growth of the economy. And the second one was that given the levels of fiscal deficit we are seeing, what are the alternative methods of raising capital? What's the ideal way to raise it internally in the country?
Yeah, look, I think the way to think about it is asset monetization. Whatever are the old assets that you have in your balance sheet, which are not playing a big role, they're pretty inefficient out there. Can you get them off your balance sheet and use the same money to produce new assets, which will be critical for growth, new age assets? And I think that's how we need to think about it. And it doesn't just, it's not just as stake sales, it's not just privatization, but it's also things like monetization of the land holdings that the government has. So I think it has to be sort of a broader bucket looking at many things. I'm a big fan of privatization, far more than disinvestment, of course. But we'll have to see. Like the government did make some grand plans in the budget, but we'll have to see if it sort of works out. I think if it works out, it's a good strategy. It's a great way to get new money to make new age assets. That's my view on disinvestment. On raising revenue for fiscal deficit, well, I think, again, all kinds of asset monetization is key. Continuous asset monetization, fixing the GST. There's just so much that can be done out there, from IT improvements to getting fewer rates to getting more products included. There's just a lot of reforms that can happen there. And I think there are plans to get some things done in the next couple of quarters. I hope some of them come through. The other one would be the direct tax code. I think that's a reform that has been waiting for a very long time. My only worry there is that it's very easy to mess it up, further rather than improve it. So I'm just hoping that whatever we finally, vote for, finally get, is actually good for revenues over the medium term.
Two different questions coming in. I'm throwing them to you, Jahangir. You can take your pick of which one you want to answer. One is on the Atmanirbhar policy and whether that could boost the economy and drive India towards self-reliance. And the second question is about the Farm Bill and why the government couldn't structure the agri sector instead of making essentially a view on the Farm Bill, I presume, is what the audience is asking for.
So I think the first question, answer to the first question is that, you can't have, $5 trillion economy as an objective, Atmanirbhar as an objective, self-reliance an objective, current account will not go above 2% as objective. You have to decide what you want to be. If you want to have a $5 trillion economy, then chances are that you have to rely enormously on the global economy. And just to make a point that Montek made, I wasn't saying that we need to move away from export. I think export reliance, without export, we can't really grow at $2,000 per capita income economy. I was just saying that we need to add to it another engine of growth because that engine of growth is spluttering at this point in time. So to me, Atmanirbhar, self-reliance are great aspirational things, I think, but the way you reach it, if you reach it the way in which Pranjal is afraid of, which is that you start raising tariffs and do import substitution, that's a terrible way of doing it. If you do Atmanirbhar and self-reliance by saying, I'm going to be the largest market, I will have the largest market share in, let's say, semiconductors, that's a great way of doing it. So I think it is what you mean by self-reliance, rather than that self-reliance has to be everything that's produced inside India. Every country under the sun right now, every emerging market country under the sun right now wants to be wants to be a manufacturing hub for producing things and exporting. All of us can't be manufacturing hubs. So some of us will have to be consumers of things. So I think it's a good aspirational thing to do. Again, like everything else aspirational, the devil is in the details. On the farm bills, look, I'm not an agricultural expert. I probably can't even distinguish a blade of grass from a rice plant. I know a bit about the financial sector, so I'll use the financial sector analogy instead of the agricultural sector. So as far as I can see, that if I look at the three agricultural bills together, the essential argument is the following: that intermediation in agricultural production had added massive inefficiency. Therefore, deregulating intermediation is going to increase the efficiency of the agricultural sector. If that is the principle of making these agricultural farm bills without going into any specifics, whether it's MSP or whether you can have contractual arrangements and all sorts of issues. But let's not go into the details. If that's the principle, which seems to be the reason as to why everybody's saying, well, the farm bills are going to be great because it is going to deregulate intermediation, and deregulating intermediation is going to improve the efficiency of the agricultural sector. Well, if it's good for the goose, it must be good for the gander too. So why aren't we talking about exactly the same thing about banking sector? So let's deregulate the banking sector. Let's deregulate insurance. Let's deregulate intermediation and telecom. Let's deregulate intermediation in the electricity market. And I think that we would not do that. We would not go and say, look, let's have banks without capital. Let's have banks without provisioning. Let's have banks without RBI supervising it. Banks are essentially intermediaries. They, instead of intermediating potatoes, they're intermediating savings. That's the only difference. And I think that the issue that I have is that, without going into, as I said, in the details, and I'm not the person who knows enough about the agricultural sector to say the details, that this principle of that efficiency by way of deregulating intermediation is an argument, but that cannot be the driving force of a sector which employs 40% of the population and 16% of this thing. Because if that was the case, we should then say that all regulatory changes in India will be aimed at deregulating intermediation to some extent or the other, because that is the way efficiency increases. So, and that's where the issue is. Where is the regulatory authority that actually goes and regulates the new agricultural intermediation policy? And it isn't that we haven't done that, by the way. We did that in 91, 92, when we deregulated dairy farming. And within about a year's time, we went back in regulating it, because between 91, 92 and 92, 93, serious questionable quality of milk products started proliferating the market. So it isn't that we haven't tried deregulating agricultural sectors. We have done it. So my issue is that, is it a principled stand, or is just something that we have done where the implementation regulation that might come in a year's time will once again get us back to a regulated intermediation as we have done before, maybe a different kind of a regulatory body?
We have about 5 minutes left. There are two questions linked to the global economy, Dr. Ahluwalia. I'll pose them to you. One is on India's relationship with the global economy. How much of a role will it play in India's growth story in the post-pandemic world, especially given the high levels of liquidity that prevail globally? The second is similar, although it talks about the need or an attempt to draw in longer-term flows via FDI into development projects while this low interest rate environment and surplus liquidity environment prevails overseas.
You're on mute, Mr. Ahluwalia. Still on mute.
You're on mute.
All right. I was only saying that you were on mute. Problems of the COVID age. But go on, sir. Did you hear my questions?
No, the last one. Actually, can you repeat them both? Because
yes, they were both linked to the prevailing global conditions. One was, how does the Indian government try and draw in longer-term flows via FDI into development projects, given the prevailing low interest rate and surplus liquidity situation globally? And the second one was similar. How much will the global story dictate India's growth story?
Well, look, as far as FDI is concerned, I mean, there are really two things the government of India can do. One is to essentially get rid of the restrictions that prevent FDI from coming in. But of course, as Jahangir said, FDI is only going to come in where they want to come in. He feels that the liberalization in insurance is not going to lead to a big inflow. I'm not sure about that. I mean, I think insurers have been wanting to have a majority stake in foreign insurers have been wanting to have a majority stake in these companies. And if they take a longer term view of the Indian economy getting back to good growth, I think they will come in. In many other areas, they actually are coming in, not as much as in China. I mean, this is the big problem. India always loses out if you start comparing it with China. China's a whole different ballgame. But if you look at whether FDI is coming in compared to what it was 5 years ago or 10 years ago, the answer is it is coming in. So I don't see that the biggest problem there is to create a business environment in which foreign investors feel this economy is going to grow at 6-7% per year. I would say 7 plus, but then get back to 6 and then get back to 7. The moment that signal is there, I think there will be an inflow of foreign investment, and indeed there has been an inflow of foreign investment in the last several years. Now, as far as global conditions affecting the Indian economy, of course they're going to affect the Indian economy. One thing is the massive global liquidity with huge amounts of money sloshing around is probably the dominant reason why in a year where GDP has tanked, unemployment has increased, lots and lots of the weaker sections have lost out. Everybody says that poverty may have increased. The World Bank usually gives these numbers, X 100 million people or whatever. But the Sensex is 84% higher than it was last year in February. So, this is clearly a disconnect between what drives portfolio flows and what's actually going on in the short run. And maybe these portfolio fellows are anticipating that the economy is going to do hugely better, so they're kind of coming in. I don't know. But there's no question, and I agree with what Jahangir said, and I think what Pranjul also said, we are not in an environment where we should be giving up on global trade. Our share of trade is so small that a halfway serious effort to sort of improve it, it should be possible to do so. Not because we'll become more competitive than, say, China, but China is vacating many areas. And India could very easily get in there and compete with Bangladesh and Vietnam if we got our act together. So that's really what we need to do. But I think if you like, the perceptions of Atmanirbhar as a kind of keep foreign trade out, that's not what the government has actually said. The government says we want to sort of lock into global supply chains, which is very good. But some of the actions, like I would have said that the RCEP, the Regional Comprehensive Economic Partnership Agreement, which has the ASEAN countries and a few others, where India has been an active negotiator, it's a pity that we appear to have decided to stay out, at least for the moment. Like, I think if we want to give a signal that we're open to business, that we want to latch on to global supply chains, we're going to do what is necessary domestically to improve our competitiveness, we should join RCEP. And I think from a geopolitical point of view also, it makes a huge amount of sense. But whether that will be persuasive, whether government will find that persuasive, I can't say, but it's very clear to me. And increasingly, many people are saying this. So let's see how movement proceeds. I think there's a big problem here. Some of these things are not policies, they're slogans. I mean, Atmanirbhar is not a policy, it's a slogan. It's a good sounding kind of slogan which says we must make India strong. It's impossible to disagree with that. What you need to do is to move from the slogan to policies and programs. Programs are ways of spending government money, and policies are policies which change government policy. And you need to combine that with targets. So it's only when you link up with policies and programs and relate them to targets that we can have an intelligent discussion of what we want to do. I mean, as Jahangir said, and we simultaneously want to have an increase in foreign inflow, but we don't want to have an increase in the current account deficit. Now, either we don't want foreign inflows, in which case we're going to live with a small current account deficit. If we want foreign inflows, we're going to have a larger current account deficit. But then if imports come in, we shouldn't be saying, oh my goodness, this is really violating basic economic rationality. So I think there's a lot of political education that needs to be injected into the political debate. I don't mean the government, I mean the political debate in general. And I think it's a big role for Indian business, which I think, if you ask me, has been singularly absent in raising the level of debate on these issues. Indian business did extremely well because of the liberalization of 1991. You would think that if there's a danger that this might be undone, then they should play a much more active role in educating the politicians and the political system that, look, we're ready to compete. Only thing is, you've got to do X, Y, and Z for me. I mean, they're right. There's lots of things we have to do. But the debate should center on we're ready to compete, providing you do A, B, and C. That's not the way it's kind of coming up. I mean, nobody's making that point from the point of view of industry.
Well, that's an interesting point not discussed earlier. We've got a ton of questions, but I think we are running out of time. So I'm going to hand back to Abhishek to conclude, perhaps. Abhishek?
Thanks so much, Hira. Thanks, everyone. It was a very enriching discussion. Wonderful to have you all here. Unfortunately, we have run out of time. On behalf of the entire India conference team, please allow me to express my heartfelt gratitude to all our esteemed participants. Thank you all for your time and for sharing with us valuable insights about the future of the Indian economy. And of course, a sincere thanks to all our participants who joined us from across the world to be part of this event. Also, as a reminder to everyone, we have a host of exciting events planned for the day. The next session is a keynote by Mr. Ajay Banga, CEO of MasterCard, where he would share his vision for the future of fintech and India's role in the global fintech revolution. Please do visit the conference website, indiaconference.com, for the Zoom link to this event. Once again, a big thank you to all of you for joining us today. Thanks so much.
Bye-bye.
Thanks very much. Thanks for the invitation. Bye-bye.
Bye. Thank you.